Hello everyone, my name is Manan Patel. Welcome to part 3 of Dream Investing 101 videos. I hope you guys watched my first 2 videos. If you have not watched that yet, please go and do that because every video that we will post will be related to all of the previous videos. And it is important to go and watch them. Before we get started, please make sure to like, subscribe, and comment. Now let's get started. Let's start with understanding what volume is. Volume is the total amount of shares traded for a particular stock in a given time period. You may have also heard other investors talk about average daily volume, which means the average number of shares traded within a day. So why is volume important? Well, volume can be an indicator of market strength. When a stock tends to go up alongside increase in volume, it may show that this particular stock is showing great signs of strength and the stock may have a bullish upside. Same goes for when the stock is going down and it is experiencing an increase in volume. There may be a bearish downside. High volume stocks typically mean that more investors have an interest in buying and selling them. These high volume stocks tend to be more popular and well known compared to very low volume stocks. Like I mentioned before, volume can be a good indicator in which it can help confirm price trends and give a warning about a market reversal. An example of volume can be when, suppose, a stock has a volume of 1,000, which means that a total of 1,000 shares were traded during that time period. Keep in mind that if an investor sells 1,000 shares and another investor buys those 1,000 shares, the volume will be 1,000 shares, not 2,000 shares. Now that we understand volume, let's try to understand a very important aspect of value investing, which is the PE ratio. The PE ratio is a metric that helps investors assess the market value of a company relative to its earnings. The PE ratio is only applicable for companies who are making money and have earnings. Otherwise, those companies without these criteria have a PE ratio of 0. One of the things that has been said about the PE ratio is that a high PE ratio means that the stock is overvalued and a low PE ratio means that the stock is undervalued. Through my research and analysis, that is not true. A lot of the times, a high PE ratio does mean that a stock is trading at a higher price relative to its earnings. But still, it can also suggest that investors are expecting high future growth, which is causing the stock price to go up. Throughout my research, sometimes high PE ratios can be cheap at certain times as well. What I mean by that is a high PE ratio for a stock that has more room to grow because of its amazing forecast or really high sales and revenue can cause the stock to go further, which is why a high PE ratio can mean that investors are really favoring that particular stock and that they are very optimistic about it, in which high PE ratio stocks do tend to give a higher return on investment compared to a lower PE ratio stock, which is why low PE ratio does not always have to mean that the particular stock is undervalued. It may also suggest that the stock is kind of dead and is not moving and is staying in a consolidated phase because that particular stock is not being wanted by investors right now. So at the end of the day, it is important to compare the PE ratio between companies in the same industry, as well as see what that company can do and its potential to grow more in the future. Simply investing based on the PE ratio itself is not a very good idea. You need to consider other things as well in your investment decisions. Now let's talk about market cap. Market cap is the total dollar value of a company's outstanding or total amount of shares. In other words, market cap helps investors assess how much total is the company worth. The market cap helps investors judge the size of a company. For instance, a small market cap stock would have a market cap from $300 million to $2 billion, while a medium cap stock would have a market cap of $2 billion to $10 billion. And a large cap stock would have a market cap of $10 billion to $200 billion. Now that we understood what the market cap is, let's talk about earnings per share. Earnings per share is a company's net profit divided by its outstanding shares. The earnings per share helps assess how a company is doing. It is used as a good indicator to help investors see the profitability of a business over a period of time, which can be quarterly or annually. Note that a high EPS will attract more investors, typically because it showcases the strength of the business. The reason being is because investors will tend to pay more for stocks when the company has higher profits relative to its share price. While a low earnings per share would not mean that the company is going to go bankrupt or something bad will happen, but it just shows that the business is more inclined to use their money on growing the business, which may be temporary or for a longer period of time, depending on how the ventures the business decides to take. Because the EPS is the company's net profit divided by its outstanding shares, a low EPS would sometimes indicate that the company is currently focusing on using its profits on growing the business, which is why they may have a low EPS temporarily. While on the other hand, a negative EPS just showcases that the business is losing money or not making a profit at this point in time. It is very important to look at the EPS over a certain period of time, whether that is every quarter or every year. You want to check the EPS and see how the business is doing overall. If a high EPS starts to go down for the past couple of years, it may not be a good sign and can be a possibility of the stock going down if the business has not invested that money on future growth. Just keep in mind that the stock market is a forward-looking mechanism. Even though the EPS may be low, going down, or even negative, if the company forecasts more growth in the future, the stock will tend to rise a good percent of the time. Therefore, it is important to look at the EPS over a period of time rather than glance at it and make a decision. At the end of the day, investors want to see more growth. Sometimes a low or downtrending EPS may be fine at the expense of investing in future growth of the company. So what exactly is beta? Beta is the measure of the particular stock's volatility in comparison to the overall market. So how do we measure the beta of a stock? A stock with a beta higher than 1 means it is typically more volatile than a stock with a beta less than 1. For example, if a company has a beta of, let's say, 1.2, then it would mean that the stock on average is 20% more volatile than the market. So who uses beta then? Beta is best suited for short-term option traders who are looking to invest their money in something volatile. You do not need to worry about what options are at the moment, but just remember that beta is best suited for short-term option traders who are looking to strike big with volatile investments. Thank you guys for watching. That was the end of part 3. Hope you guys liked it. If you guys have any questions, please feel free to email me and I will get back to you as soon as possible. I hope you guys liked my video. If you guys did, please make sure to leave a like, comment, and hit the subscribe button. Thank you, everyone. Have a nice day.